I don't think trading is a game. Everyone always thinks it is, but like trading is the only game where you could see your cards before you bet on them. You could see the chart before you bet on the chart. Whereas if you go to the casino, you bet and then they give you the cards. And August 14, I made the most money on it, $75,000.
Nice.
But had I held one more day, it would have been $200,000. So I'm just trying to keep it really simple. And I feel like most traders that do keep it simple end up finding a lot of success versus the people that overthink and overtrade and overanalyze and over everything. They kind of go crazy in here, which makes their trading crazy as well. Because the chart has all the data versus the level 2, they could very easily manipulate that level. I've seen it so many times, them putting 100,000 share bid and the stock jumps up, the bid disappears and then it crashes down, right? The reason why they do that is because they're flashing that 100,000 share bid to sell on the offer with like an iceberg order, a hidden order. As soon as they get their order, they cancel this, stock goes down. So many times traders are getting bigger when it's going against them. They're like, I have to fix my average, I have to fix my average, I have to fix your average doesn't matter if the stock is going against you. I would rather have a worse average with the stock being broken than a great average, but the stock is squeezing higher. It makes no sense. But what ends up happening is most traders, they're in 10,000 shares as the stock is squeezing up higher and killing you. And as the stock is going down, they only have a starter. If you look at the market long enough, you'll find a trade. And oftentimes that trade is not the right trade.
Most traders dream of turning a small account into life-changing money, but very few could actually do it. Today's guest not only did that, he's also built an entire career, showing others how it's done. Alex Tamiz is a full-time day trader and investor, best known for short-selling overextended, low-quality small-cap stocks. His trading edge goes beyond just patterns. He dives into filings, dilution risk, and insider activity to build conviction for his trades, all the while using technical analysis and tape reading to time his entries with precision. Since our last conversation with Alex in 2023, he has taken his journey even further. Alex has now shifted from being purely a day trader to also becoming an investor as well. In the last year, he actually made more money from long-term investing than trading. To date, Alex has generated over $11.5 million in verified trading profits, fully documented and publicly shared online. In this episode of the Humble Traders podcast, we'll dive into the art of short-selling overextended small-cap stocks without getting trapped, how to size into positions with conviction and add into your winners, how to build a trade planning process that actually works, and how Alex is balancing short-term trading with long-term investing to let his money grow even further. I know this is going to be an episode jam-packed with trading insights, real trading tips, and actionable steps that you can actually take to become a better trader. So buckle up, make sure to hit the like button down below, and please welcome our guest today, Alex Tamiz. All right. Welcome back to the show, Alex. It's been a few years.
I know, good to be back.
Yeah. Before we dive into the nitty-gritty details about your strategies and executions, could you give our audience, for those who don't already know you, a big picture of what kind of trader you are and how have you been trading the last 2 years?
Right. So 11 and a half years ago, I was a barista at Starbucks making coffee. I was making about $150 a week before taxes. And I would take, $50, $60, put it into my gas tank. The rest of the money I would use to take my girlfriend out to the movies. Long story short, she ended up breaking up with me to be with a rich guy. So I started researching how to make money in America the fastest way, real estate and the stock market. Didn't have enough money for real estate, so got started in the stock market. Blew up every single account I had. Every single time I bought a stock, it would go straight down every single time. It's like the reverse Midas touch. And eventually I discovered what short selling is, which is making money when stocks go down. Ran out of money, so I sold the rims off my car for $2,000 to fund my last trading account. Went short a stock called VGGL that delisted, shorted 2,000 shares at $4, made 50 cents a share. So instantaneously, I made $1,000. I was hooked ever since, and now here we are.
Wow. So that was how many years ago you mentioned? 11 years
and
ago?
a half years ago.
Oh my God. Okay. So, and that's what, so it sounds like you discovered short selling early on. Is that still your predominant strategy?
Right. So primarily that's kind of what I do. So my first
Okay.
year, every time I bought a stock, it would go straight down. My second year, I discovered short selling. I started breaking even in my trading. By my third year, I started to consistently make like $100 a day. Now fast forward, probably over the last 2 years, I've transitioned a little bit more. Now what I do is I take those profits from short selling and I put them into longer term investments. So I generate cash short term from trading and then invest it long term for the future to build wealth.
Oh, interesting. Okay. We can talk about the two separate aspects of trading later on.
Sure.
But for your short selling, how has that changed over the last 2 years? Short selling small cap stocks, because I'm no longer following the day to day like the low
Right.
floats anymore. But I know for small caps it's very like cyclical, changes every couple of months, every other year. So how has that short selling been like the last 2 years?
It's been a little bit tougher. It's been more saturated. So I think a lot more market participants have entered the short selling world, which creates way more short squeezes. So we see a lot of abnormal moves. Like I would say probably about 3 to 5 years ago, these stocks would cap out around 3 to 500%. They would make crazy moves, 3 to 500%.
That's a lot.
Now it's like 1,000%. Because now there's more people getting squeezed, right? And every time a short gets squeezed, they have to buy back the shares. Every time they buy back the shares, stocks go up, right? To cover their position to exit. So we're seeing way more aggressive short squeezes. So day one stocks have been going nuts pre-market because pre-market has lower volume and no hard market stops. Like a stop loss order will not hit pre-market. So a lot of these stocks get heavily manipulated to the upside due to low volume and no stops. The broker ends up liquidating them and the stock just shoots up. So what I've found that works now is instead of trying to short these day one gappers, I let them go crazy on day one and start to attack on day two, because by the time day two comes around, there's now a new stock that's taking attention.
Okay.
So, for example, you have stock A on day one going crazy, right? Stock A on day two, people don't care about because now stock B is now going crazy. So a lot of people forget about this stock, and most of these small cap stocks move based on hype. So when the hype dies down, right? The hype dies down because a new stock is taking attention. This is what happens. Stock goes down. So I try to short sell on day two and let this stock go up. Then when this stock comes on day two, there's a new stock, stock C, that takes the attention. This comes down. So I found that day two stocks are working a lot better for short selling versus day one because there's way too much hype, way too much momentum on day one on these stocks.
Yeah, I guess that kind of makes sense. Once you kind of left the day one stocks alone, you on day two when you're trading, you can use the previous day's levels like support, resistance, whatnot, and look at the volume and use that to. I imagine that's how you form your entries and your executions, right?
Exactly, because what ends up happening is all based on hype. It's all based on hype. So as the hype dies down, so does the stock price. But on day one, when the news is the freshest, when it has the highest volume, when it has the most attention, it's very hard for those stocks to go down because now inexperienced short sellers that come into the market, they say, it's up 300%. How much higher could it go? Then it goes 400%, then 500%. You're like, what the hell just happened here? And they blow up. But as an experienced short seller, what I want to do is I want to let the stock go as crazy as possible so that when the momentum finally dies out and everyone's like, oh, I'm on to the next one. Well, for me, that's the one that I'm focusing on because people forget about it.
Yeah. In that way, you're kind of also avoiding the day with the highest risk as well.
Exactly. And what that allows you to do now is on day one, you could go long these stocks. So what I'm trying to do and what I'm trying to adapt to, I'm still, figuring it out because it's, you know what it is? It's very tough to go on two different sides of the same stock on the same day. It's very tough to go long and then short the same day or short and then long because it's very tough to stay biased. Because you're like, oh, I'm going to keep flip-flopping. For me, I never found that to work. I'd rather pick a side, focus on that. So day one has way more advantage to go long. Day two has more advantage to go short. So that's what I'm trying to focus on now.
Oh, wow. Okay, so if we're taking the other side on the first day to go long, how is that process different from your short selling process? Because when you're short selling on day two, you wait for a top and that's your risk and you short into lower highs, etc.
Right.
So how would that work for your day one going long?
Right. So exactly. That's a great question. So what ends up happening is these stocks run pre-market now. They run very aggressively pre-market. So they, grind up and they set like a little bit of a top pre-market and kind of consolidate towards the market open. So what I'm trying to see is I'm trying to keep it so simple a monkey could do it.
Okay.
So if it breaks over pre-market highs, I want to go long because there's no more resistance left. Right? You could do things like buy on a VWAP reclaim, but what I've seen the most obvious thing to work is it sets a top pre-market, kind of consolidates before the market opens, kind of tries to dip and trap. And then if it breaks over that pre-market high day, as a short, you got to stop out. And as a long, you got to buy.
Oh, okay. Keep it simple.
Keep it simple.
Yeah. So what do you find the percentage split of your trades to be? How many percentage was shorts versus longs?
It's still about 90% short.
Oh, okay.
It's funny because because here's the thing. When 2020 happened, I made a ton of money going short because so much of these moves were AMC, GameStop, they were totally exaggerated. But my biggest regret is I didn't go long. So I always told myself when that type of market came back that I had to capitalize on the long side. And right now we're in one of the biggest bull markets we've ever been in since that time. So now it's time to try to take advantage of that. So I'm using that lesson I learned from, 5 years ago of trying to go long when that crazy momentum is there. So I don't regret it now. So before that it was like 99% short bias. Okay. So, 10% is still a little bit better, but, I'm still trying to improve. It's like my bread and butter. My bread and butter is shorting, right? So for example, like basketball, you use a ball and you could shoot a hoop with a basketball. Going long, going short is like a totally different sport. They both use a ball, but one is basketball, one is soccer. One I'm using my hand, one I'm using my feet. It takes time to adjust and adapt,
Yeah, that makes sense. So interesting. I haven't heard any traders say that yet about the current market right now. So you think right now it's remnants of 2020 for small cap stocks?
Definitely, because so here's the way it works, in my opinion. So the way it works is small cap stocks are basically like gambling. You have people that buy these stocks at $1, $2, and like if it goes to $10, I'm going to buy a BMW. I'm going to retire. I'm going to do this. I'm going to do that. But most of the time, they don't do that. But when the overall market goes up, right? When the indexes go up, when Apple, Amazon, etc., Palantir, Robinhood, all these stocks go up, a lot of these traders have excess capital. They have extra money in their pockets because these stocks are going up long term. What they end up doing with that extra money is they start gambling on small cap stocks. So whenever we're in an aggressive bull market, people have more cash to throw away on these small cap stocks, and that's what you're seeing is causing all of these mega squeezes as well. There's more capital being thrown versus you go back 2 or 3 years ago when we were in a little bit of a bear market and things were kind of going down. You didn't see these crazy moves because people were so worried about, Meta going down 80% or all of these other stocks going down that they didn't feel comfortable taking money, which they didn't have, to put on these stocks. So the higher the market goes overall, the crazier small cap stocks will be as well.
Oh. Actually, I think that makes sense, especially if I think they're projecting that the Fed is going to cut rates in September.
Definitely, yeah.
I think small caps, when we cut rates, you get some like crazy momentum.
Exactly.
That makes sense. More stimulus money.
Correct. Call it stimulus money. But like at the end of the day, if the market keeps going up, like for example, like if NVIDIA keeps going up or Palantir keeps going up or anything, a lot of these small cap companies, or even Bitcoin, if Bitcoin keeps going crazy the way it's going, a lot of these small cap companies, we're doing a Bitcoin treasury play. We just partnered with NVIDIA. Oh, we have a deal with Palantir, XYZ. So they use the momentum from the large cap markets to pump themselves up as well.
What are some of the tickers in the small cap world that kind of align with those themes? Just so I am also aware.
Sure. So a big one was Bitcoin and Ethereum going crazy over the past couple months.
Okay.
So Bitcoin and Ethereum hit all-time highs, are all going crazy. So what happens is these small cap companies are now introducing Bitcoin and Ethereum treasury plays. So, MicroStrategy has the Bitcoin plays. They, do an ATM to raise money. They use that money to buy more Bitcoin. They add it to the balance sheet. So now these small cap stocks are doing the same with Ethereum. They're doing the same with all these other things. So one big one was BMNR. I don't know if you remember that one. So that one went from like 5 to what the heck, like 120, 130.
Something like that. It's at like $40.
Yeah, and then it came all the way back down and now bounced. SBET was another one. $5
yeah.
to 115 came back down. So those two trades were actually two really big ones for me. So recently, probably over the past month, I probably made around like 100,000 shorting BMNR.
Oh,
And on
okay.
SBET, I made around 50,000 shorting that. Why did I do that? Because these are very highly dilutive things. So people think that, when these companies are buying a ton of Bitcoin and a ton of Ethereum to their balance sheet, that's going to be very, very bullish. But the way that they do that is they do like an ATM offering. They sell shares on the open market, diluting shareholders to raise cash. So what ends up happening is they introduce more supply into the market, more shares into the market. The shares outstanding increases, but they use that money to buy Bitcoin, crypto, this, that. But what ends up happening is the price goes down because there's more shares being introduced into the market. So BMNR, I think they did something crazy. I think it was like a $20 billion ATM offering.
Whoa.
So they diluted the company by $20 billion, which is, I think, 30 million shares or 300 million shares, something
Wow.
along those lines that they were dumping into the markets. They had to dump those shares to raise the money.
I see.
And then the stock went from, I think it was $100 down to 20. And they did it again at $70 and now it's down to 40.
Oh, wow. Okay.
So a lot, and even with SBET went up to 40 and now it's down to 18. They're adding more crypto to the balance sheet.
I see.
But they're diluting the shareholders. So inexperienced traders are like, oh, let me buy this long term. They're buying Bitcoin, they're buying Ethereum, but instead they don't realize the dilution that comes in along with it. And as an experienced trader, you could ride that wave down,
That makes sense. Yeah. And also I think I'm not an expert in this field in particular, but I was reading some articles that kind of makes sense. They're saying these treasury stocks, they're worth more than the actual crypto they own.
Correct.
So I was like, okay, that doesn't make sense, right?
Correct.
Like if these are treasury stocks, then the correlation of their market cap and the actual dollar value of the crypto they own should be somewhat more correlated
100%.
and not have like a huge gap in between.
Yeah, and traders could play like the arbitrage game and they could say, you know what, the net asset value is $50 a share, let's say. So if it's at $80 a share, I could just short it and try to kind of make the difference. For me, that's too complex. I'm not an expert like that. I don't really, I can't. I just see $20 billion ATM offering, introducing shares into the market, short it until, starts to consolidate and find its way back up,
So for that particular short you did on BMNR, what kind of setup was that for you? Was it a day trade or like a swing trade you held for a couple of days?
No, that was a day trade. So what ended up happening is BMNR was kind of ramping up because they were an Ethereum treasuries company. So Ethereum was ramping up, so BMNR was ramping up. What ended up happening is news hit pre-market that they were going to have that $20 billion offering. So I shorted it when I saw that news. It went down very, very quickly. It went down like $10 a share, covered a little bit, and then reshorted the bounce on the way back down. I actually might have a...
that's recent.
So August 13 was 47,000.
Okay. Do you have the chart?
Yeah, let me send that to you as well. And August 14, I made the most money on it, 75,000.
Nice.
But had I held one more day, it would have been 200,000.
Because it would have been a swing with a gap down over
Correct. A gap down like crazy. So those were two recent examples of like a lot of hype, a lot of craziness, Bitcoin, this, that. But aside from that, it's like every day there's just something else because like AI is hot or crypto is hot, or anything is hot. And they just like these like the people that do the press releases, the PRs, the news, they're very smart. They just put out things every single day. They don't care what it is. As long as it gets hype, that's what they care about.
Yeah, I do remember when I was trading small caps. There's always a few buzzwords that Wall Street or traders, retail, they care about. So the buzzwords would be crypto, AI. For a while, it was like shipping.
Right.
Like back in the days, like artificial intelligence, crypto.
Right.
Bitcoin. Anyways.
And it's not going to change. Next year, it's going to be humanoid robots.
Oh, yeah,
and then it's going to be this and that. It's just, or right now, the big thing is like self-driving, like all that stuff. So you're going to now start to see all these press releases of these companies are getting into self-driving technology. So like that's the thing. That's why I love it. I love it because the hype never ends. There's always something new to hype up and the pattern always repeats.
Oh, okay. And it's still, I remember your A plus setup was called the first red day.
Yeah.
Is that still
Still the same thing.
Okay, so you still use that same strategy on these different themes of hyped up stocks.
Correct. It doesn't happen all the time,
Right.
but like when it does happen, I'm all over it. Now I'm just trying to get bigger and bigger and bigger on those setups.
I see. So that would still be your A plus setup. Okay.
Definitely.
In our previous interview 2 years ago, you mentioned that traders should have like a collection of different setups and you grade them and then you size in based on the quality of those plays. So if A plus setup for you is the first red day setup, what would be like an A setup and B setup for you?
Sure. So A plus is first red day.
Yeah.
So just a quick recap on that is a stock would need multiple days of extension, right? So a stock goes from on day 1, 3 to 6, day 2, 6 to 12, day 3, 12 to 20, day 4, 20 to 40. And then when it finally goes red, short as much as you can because it's probably going to crash 30, 40, 50%. So that's my A plus. Doesn't happen all the time because these stocks may not make multi-day extended moves like that, right? It probably happens once a quarter. Still a decent amount, but it'd be nice if it was every day. It just doesn't exist. So that's the A plus setup. Okay. Something under that, I would say, is just pretty much basic shorting into resistance, right? Okay. Stock sets a top, stock sets a resistance, stock bounces to resistance, has a death candle, showing a fail and piggybacking that trend down. That's something I would call like a B plus setup. Occurs pretty damn often, pretty repeatable, great. Something worse than that, I would say C setup is maybe like a basic VWAP rejection, right?
Is that still a short?
Yeah, it's still short. Okay. So it comes down, like what I like to see is I like to see a stock either, rejecting the high of the day or rejecting the pre-market high day. So like, for example, the example of going long, if it reclaims the pre-market high, the inverse is if it pushes the pre-market high and then just slams down.
I see.
So it gets everyone excited, gets short sellers to stop out, gets long traders to buy, and then just does the opposite. It reverses on them. So if I see that, that's probably high probability that there's enough volume traded, enough traders stuck that's probably going to be the top for the day. Kind of comes back down. And then I would say like a C setup is just a basic VWAP projection. They occur pretty much all the time, but it's not as, easy to make money on because you're not going to size up on every single VWAP projection, right? You're going to take small size. It's going to be like finding $100 on the floor. Yeah, you're going to pick it up, but like it's not like something that you're going to bet hundreds of thousands of dollars on a VWAP projection, right? And then just like a bad trade is like, any type of boredom, emotional, so here's a good example. So I think a lot of traders, when they show up to the markets, they feel like they're owed a paycheck. Like you show up to the desk, I turn on my computer, I sit in front of my screen, and I deserve money. It's not really like that. And the problem happens is because when you go to work and you go to your day job, you could screw around, you could mess around, and you'll still probably get a paycheck, right? But in the trading world, if you show up, you're not guaranteed a paycheck. So what I say is you show up and you wait for your opportunity. If your opportunity is there, if your setup is there, trade it. But you're showing up to see if that opportunity is there. If there's no opportunity, people start to gamble. They're like, I showed up today and, this stock looks really good. Like, let me just try shorting it. And then it does the inverse. So you're like, wouldn't it have been better if I just didn't trade today? Right? So I think that's what people really need to understand is show up to see if the opportunity is there. Don't show up to force a trade. So any type of trade that is forced or any type of trade that's emotional is a DF horrible setup. That's how you lose money. You lose money by just like treating trading like gambling. I don't think trading is gambling. Everyone always thinks it is, but like trading is the only game where you could see your cards before you bet on them. You could see the chart before you bet on the chart. Yes. Whereas if you go to the casino, you bet and then they give you the cards, right? In trading, you could just look and wait to see your exact chart show up. And if your exact chart shows up, then you bet on it. That's a huge edge.
That is true.
That's a huge edge.
Yeah. I think there's this misconception that being a consistently profitable trader means you're consistently making money every day, hence consistently placing trades every day. Right. And that's a huge mistake, right? From what you just said, being consistently profitable means you show up, sure, daily, but you're disciplined enough to know when to bet and when not to take trades.
Definitely.
That's the big difference.
Definitely. I mean, Bao, but Bao says it best. He says it's cheaper to shop on Amazon than to place a boredom trade.
That is true.
Right? If you're bored, just go shopping for a little bit online. It'll cost you like $100.
Yeah.
But in trading, people go boredom trading and they lose 500, 1,000, 2,000. They're like, damn it. And then what happens is you're in the drawdown. And the next day comes and there's a really good setup and your mind is not okay. You're in a drawdown. You're like, you know what? Like this setup looks good, but I lost money yesterday, so I don't want to size up on it. And then the trade does exactly what you want. You're like, damn it, what just happened, you know?
Then you end up missing the play that you should have bet more on.
Correct.
Yeah.
Exactly.
So where do you shop when you're bored?
I just walk away. I just walk away.
Okay,
so
that's good.
So for me, my wife does enough shopping for the both of us, right?
Oh, okay.
So I just have to, I just walk away.
Okay.
Yeah, no, like for me, I just try to stay busy, right? Like I'll exercise a little bit. I'll go outside. I'll go for a walk, or like I'll call my mom on FaceTime. I just find anything to keep me busy and keep me away from the market, because if not, I'll find something. If you look at the market long enough, you'll find a trade. And oftentimes that trade is not the right trade. So usually my rule is around 10:30 a.m. If I'm unable to see an opportunity, 10:30 a.m., I just cut it off. I cut it off and I'm done for the day.
Oh, yeah. I remember you're basically trading an hour a day, right? Because do you trade pre-market?
Not really. I show up pre-market to see how the stocks are trading. But what I found is, for me, if I trade pre-market and I have a bad trade, it screws up my opening trades. But if I have a good trade, it's nothing. It doesn't change anything for me.
I see.
So I would rather let the stock trade out pre-market, be calm, cool, and collected, and then attack at the open versus emotional, stressed out. Like if you trade pre-market sometimes, it's like you traded a full day without the market even opening.
Yeah.
You know?
That's true.
So I don't need that stress. I would rather let the chart form, have more data, and then with that additional data, place my trades at the open.
That's a very smart approach. Yeah, I used to trade pre-market as well. I'm like, nah.
It's like the pre-market is like the wild, wild west. It's like crazy, you know?
Yeah, easier for stop hunt and all that. But
leave it to everyone else. We'll stick to the easy stuff.
Speaking of pre-market, and you said you do show up pre-market to prepare. What is your current trading process or like trade planning process like, since it starts pre-market?
Right.
Can you walk us through some of the steps you do every single day?
For sure. So let's start from like the basic beginning. So
sure.
Probably wake up so I try to, like I said, like let pre-market trade out, but sometimes if you're awake too early, that kind of hurts you as well, because you sit there and you're like, I've been sitting here for 2 or 3 hours. Like, let me do something. So like that kind of hurts you too. So I try to wake up a little bit later. I try to wake up around 7 a.m. New York time.
Yeah.
So 7 a.m. market time. So first thing I do is I check my phone. I see if like the overall markets are gapping up and gapping down. Kind of gives like a sentiment check for the day, right? Did Trump say something crazy, or like is there a deal with China or whatever it is? I try to look at the market, right?
Yeah.
Next thing I do is I make my coffee, because without my coffee, I'm a zombie. And then I get to my computer. When I get to my computer, the first thing I do is I check the top percentage gainers of the day, right? So the top 10 or 15 stocks gapping up with the highest percentage.
Okay.
From there, I like to read the news on each of them. Sometimes they don't even have news, right? So I like to read the news. And then if I read the news, I try to see if they've posted the same news before. A lot of these small cap companies, they post the same news like 5 or 10 times. So I want to see if it's like a rehash news, or if there's no news at all, or did they partner with NVIDIA or something like that? So once I see the news, I try to narrow it down from there. If they partner with NVIDIA, if they partner with Walmart, I got to get rid of that, because it's very easy to be hyped up. If the stock has no news, if the stock's news has been posted before, or if it's just like a letter of intent or a contract with no number in there, it starts to get interesting. After I look at the news, I look at the filings. There's a bunch of things online now that you could check the filings with. You know, back when I first started, you had to learn the filings, but look at the filings. Is there any dilution? Are there any warrants? Are there any ATMs? Okay. Next, what I do is I look at the daily chart. So I've now narrowed down 20 stocks. So I go 20 stocks from the scanner. I read the news on all of them. Now I narrowed it down to like 15 stocks. After I narrowed it down to 15 stocks, then I look at the filings. It narrows it down to 10 stocks. Now of those 10 stocks, what I do is I look at the daily chart. Is it a stock that's, creating some sort of daily chart breakout? Or is it a stock that's just been like this? That meme like on Instagram where it's like, the stock goes down and then it bounces like a little bit and people are like, yeah, like they're excited, right?
Yeah.
So I try to find those like stocks where it's been trending straight down and it kind of pops up a little bit. Or I try to see stocks that every time it pops up, it comes back down on the same day. Pops up, comes back down. After I see a chart that's, mostly downtrending, or a chart that every time it pops up, it comes back down, that narrows it down even more. That gets it down to like 5 stocks. Now, of those 5 stocks, I see how it's trading pre-market. Is it consistently going down pre-market, or are they creating higher lows and higher lows and higher lows? If they're creating higher lows and higher lows, chances are it becomes that crazy stock that runs 1,000%. I X that out. I look for the stock that's breaking down pre-market and try to join that trend. That narrows it down to like 1 or 2 stocks. And if it bounces to resistance, I short it, and that's how I make my money.
Oh, I see. I like how that you have like a complete, this is a 10-step process or something like that.
Yeah.
Oh, so what kind of tools are you using? Because you mentioned that you first scan for the gappers, then you look at the news and then check the dilution. What kind of tools? I don't know how many you are using to do each of these steps.
Right. So it's actually really funny. So when I first started trading, I didn't have money for any of these tools, right? They're all like 200 a month, 300 a month. So I didn't have the money. So I always went with like whatever I could do that's like free, right? So
okay, that makes sense.
And even though I've made a ton of money now, it's very rare that I pay for a lot of these things. So I'll give you an example.
Okay. That's good.
The top percentage gainers, like I use like DOS Trader as like the platform, and they populate with the top percentage gainers.
Yes.
So that's that.
The top list. Okay.
The top list. Exactly.
Yes.
So I use that. And then I go on like Yahoo Finance or FinViz to find the news. It's pretty much on there, right?
Oh, that's it?
That's pretty much it.
Those are free too. Okay.
It's free.
Yeah.
And then I use that. And then from there, the chart is already my platform.
Yes.
That's free. The only thing that I pay for is dilution tracker. I use that, and I'm not too sure how much it is these days, but it's negligible. And I use that for the filings. I know how to read the filings. I know how to do all the research, but if the tool makes it, if the tool makes it readily available for me, I'd rather pay that. But aside from that, I don't really pay for much other things.
Okay, that's good. That's encouraging for the viewers, especially
I was cheap when I started, so I just kept being cheap, I guess. I don't know. I mean, I could afford to do it now, but is it really going to change anything for me? Not really right now. Not really.
Okay. Keep it simple.
Keep it simple. That's my entire motto, because like I really wasn't like the smartest person always. I always would just try to keep everything as simple as possible, like always. Like I think that's what works. People try to overcomplicate things, like analysis by paralysis. Like, when I'm trading and someone asks me a question, they're like, how much percent did you cover on this? Or how much percent did you add? Or how much percent this, that? And the problem is they're looking for like a standardized answer.
I see.
Like it's not 16.23% that I'm covering. It's not 18.97%. It's mostly like by feel, or it's mostly by like what I'm seeing on the charts. So it's not linear. It's not exact. I'm not always covering a third of my position. I'm not always covering a half of my position. If I see that there's more room to the downside, maybe I take 10% off and then I let it ride. Or if I see that's a little bit too volatile, maybe I'll take a little bit more off. But I think people are always looking for, all right, when you're scaling in and you're sizing up, you go 22.2% here and 36.5%. It's not like that, right? So people like overanalyze. And I was never like that. I always try to keep it simple. If the daily chart is weak and every time it pops up and pops back down, chances are history is going to repeat itself. If it's under pre-market high of the day, chances are pre-market high of the day is going to be the top. And if not, I'll stop out there. If it's a first red day setup coming up, I should probably be bigger because that's how I make all my money. So I'm just trying to keep it really simple. And I feel like most traders that do keep it simple end up finding a lot of success versus the people that overthink and overtrade and overanalyze and over everything. They kind of go crazy in here, which makes their trading crazy as well.
Right. That's very interesting. It sounds like you're more discretionary as a
Definitely.
Okay. We interviewed a couple of system traders before, and they say the discretionary traders who are profitable, they're actually just very disciplined. They're very disciplined. So they think like a systematic trader in their head. Like you might not be able to write it down or kind of like categorize it into like all the specific numbers you mentioned. But in your head, everything's very systemized. And then you know exactly what to do if you see certain scenarios. Would you agree with that? Or
Yeah. I mean, I would love to like eventually create some sort of algo or some sort of robotic trading, but number one, it's very hard to find someone you trust and requires a lot of work and a lot of testing. But I think that like I would love to at least just like explore that route because, I've talked to other traders and even some of the owners of these brokers, and what they tell me is the algorithmic traders are always the ones making the most money because the robot is sticking to the rules. The robot is stopping out. The robot is kind of making those hard decisions. As sometimes as traders, we get a little bit emotional. We don't make those hard decisions. So it'd be very interesting to see if I could take this exact strategy, whether it be shorting into resistance, first red day, or even long buys, buying on the pre-market high the day break, and kind of creating some sort of robotic, algorithmic AI version of myself to do the trading and see how it compares. So any developers out there, any people, email me, alex@myinvestingclub.com. But no, seriously, it'd be very interesting to see because like, I think that that'd be almost like the future of trading with AI, robotics, and all this stuff. Yeah, I mean, it'd be interesting. I'd just be curious, right?
Yeah.
It might be horrible, right? It took me years and years to learn. Maybe it's going to take the robot 2-3 years to kind of learn and adapt. But also the problem is the market's always changing.
That's
so
true,
you have to make sure that your robot is changing too. Imagine you programmed, an algo in 2020. By 2022, it probably lost all of your money.
That's true. You need to like go back and like update it and stuff like that.
Right. It's interesting. Maybe for the future.
Yeah. It makes sense because a bunch of things you said, basically trading is a bunch of if and then statements.
100%.
Right? So for you, it's like, if the stock is below pre-market highs, if it's making lower highs and making lower lows, then you short into resistance.
Right.
So if you can somehow program that, you can create a Alex AI.
It would be interesting. It would be interesting.
Yeah, you should get that domain, alexai.com.
Believe it or not, I was looking to buy my own domain because I don't own alextemes.com. And I tried to buy it. I'm offered because someone else owns it somehow. I offered $1,000, $2,000. No one took it. So I don't own my own domain, but alextemes.ai is available. So I own that one. So maybe I could use that. Yeah, maybe I could use that.
Foreshadowing what's to come.
I didn't even know they had .ai domains.
I didn't know that either. Honestly.
Make sure to buy your domain.
Oh my god. Okay, I need to buy it before this episode
comes out.
release. Otherwise, if people will like jack it up and like sell it to me.
It's crazy.
Yeah. Somebody tried to sell me, this is off topic, but somebody tried to sell me because I'm humbledtrader.com. Somebody tried to sell me humbletrader.com. And I was like, okay, how much you want? 10,000.
Yeah. Someone owns my last name for like $72,000. Some person in freaking Asia. I have no idea. Hong Kong, something like that.
Is your last name very, this is very unique? Like it's not a common last name or?
I think it's unique, but who the hell's buying my last name on these domains, dude?
I don't know.
As soon as I figured that out, I bought the domain on myself, my wife, my brother, my cousin. I bought everyone's domain because I had no idea. You never know.
Yeah. It's a business though, like to own a bunch of domains and try to resell it.
It's like the mafia. Like they own everything. You either pay up or you can't get anything.
Yes, that is true. Okay. Going back to your trading process and your trade planning routine every day. You also mentioned that, yes, you do the research and you are ready before the open and you're done by 10:30 a.m. Why so early? That's literally only an hour after, right? Because a lot of these small cap stocks, they, especially if the short selling for that stock is working, they continue to fade.
Right.
Like, so why do you usually have that 10:30 cutoff time?
Yeah, it's a great question. So when I first started trading, my mentor, Bao, the guy that taught me how to trade, we were trading every single day together, right? And we would make money pretty much every single day. But towards the end of the day, we were giving back money. And why was that happening? So what was happening is the stocks are making the predictable moves in the morning. And then after 10:30, the volume would shrink, the algos would take control, and the stocks would end up rebounding. So we were holding these stocks like all day fades and trying to hold for longer, bigger picture moves, but they ended up chopping around towards the rest of the day. So we create something called the zombie rule, which is at 10:30, these dead stocks come back to life like a zombie. So I stopped trading at 10:30 because I recognized that me and Bao were giving up like, $500 to $1,000, maybe even more of our profits every single day by overstaying, by over trading, by doing too much. Because when these algos come in, the volume shrinks, they could push the stocks right back up. So I stopped trading because I started doing math. I was like, wait a second, like me and Bao are losing like $1,000 of our P&L trading all day. Well, $1,000 times 252 trading days in a year is like a ton of money, right? It's $250,000, right? So if I just stop trading at 10:30, I should make an extra $250,000 by not losing the $1,000 that I was losing. So I cut off my trading at 10:30. We created the zombie rule. And ever since then, I've noticed it's been happening like for 11 years now. At 10:30 on is when these stocks start to rebound. They get a lot more choppy. And the choppy action, I don't need to deal with it. Plus, walking away at 10:30 gives me the freedom that I wanted when I first started trading anyway. Everyone always gets into trading for freedom. And then once you become a trader, you trade all day.
Yeah,
doesn't make sense.
That's super ironic.
It doesn't make sense. So that rule not only protects my capital, it keeps me out of trouble and lets me enjoy my life.
Oh, okay. So you're done by 10:30.
I'm
done.
I'm done.
That would be 7:30 a.m. here in Vancouver.
Yeah.
Wow. Okay. So, but okay. That means for those who are more focused on longing, they can start looking at stocks to go long, take the long side, the opposite after 10:30.
100%. That's one of the strategies that we use, right? So I stopped trading at 10:30, but I know a ton of traders that we've helped that literally at 10:30 is when they start their trading.
I see.
Right? So at 10:30 is when they start their trading because that's what we found is an edge. If I stop trading at 10:30 because these stocks are zombieing, coming back from the dead, the only logical thing is if they keep zombieing, let me profit on that, right?
Yeah.
If I didn't have other responsibilities, if I didn't have anything like that, I would definitely be going long at 10:30. But these days, I'm answering questions, I'm making videos, I'm doing this, that. So I'd rather use that time for myself than to try to make a little bit more money.
Yeah, that's what I love about trading. Two traders can be looking at the same stock, have the opposite thesis, but they can both make money depending on their execution timing, how long they hold the stock, and what their thesis is like.
Right.
Yeah, there's definitely more than one way to make money in the market.
It's incredible. It really is because, for example, Bao and I trade sometimes the same stock.
Okay.
But our executions are totally different because we're two totally different personalities. So we could trade the exact same stock, both make money on the exact same stock, but execute in a totally different way, right?
Yeah.
He's more like, he's more crazy. So his entries are crazy. I'm more like, very calm, like one shot, one kill, or scaling in slowly, or just, it's a much cleaner chart. Or it's about like a Christmas tree. But that's his personality, right? We're both making money. We're both trading the same stock, but based on your personality, you may execute in a different way.
Speaking of you scaling in our last interview from 3 years ago, there was a lot of questions of people asking you, okay, what's your rule? Maybe you don't have like a systematic way, but what's your rule inside your head when you are scaling or adding into these trades? Like, do you have some examples that you can talk about?
Yeah. So there's something that I use called the 30% rule.
Okay.
So what does the 30% rule mean? So we're going to use shorting as an example here. So we want the stock to go down. So if a stock is going up, it's going against you in this example.
Yeah.
So what I started to do is when I first started trading, I would just aggressively start scaling. I'd just be scaling and scaling and scaling. And, it's that common thing of you just keep adding to a loser and adding to a loser until you blow up, right? I made that mistake gazillions of times. So I had to create a process to fix that. So what did I do? So if a stock is above VWAP, meaning that the average price that people hold the stock, right, is the VWAP. If it's above that, chances are it's a very strong stock, right?
Okay.
If its stock price is above VWAP, it's strong. So what I've created is I've created a rule that I'm not allowed to use more than 30% of my max size as the stock is above VWAP, right? So if the stock is above VWAP and I want to go down, it's showing that the trend is strong. So 30% of my size I use above VWAP.
Okay.
I will not add until either a break of VWAP or a death candle. If I see a break of VWAP or if I see a death candle, that means that the stock is now going in my favor.
Okay.
And I get to add more aggressively. I could add 50%, 60%, however it is based on the setup. But what this 30% rule does is if the stock is going against me, I'm no longer adding to a loser past 30% of my size. I also recognize That's a lot easier to stop out of a stock when you're wrong when you have less size. If you're in full size on a stock, it's really tough to hit that button. It's really, really tough. But when you're using small size, it's easy. So if the stock is going against me, 30% max size only, and also, I no longer am adding to a loser. I'm no longer scaling up to the moon just trying to fix my average. What I've really, really done definitely this year is I'm only adding if the stock is going in my favor. I'm only getting bigger if the stock is working. So many times traders are getting bigger when it's going against them. They're like, I have to fix my average. I have to fix my average. I have to fix your average doesn't matter if the stock is going against you. I would rather have a worse average with the stock being broken than a great average, but the stock is squeezing higher. It makes no sense.
That's true.
Right?
Yeah.
So for example, stock is $5, right? I would rather have a $4.50 average as the stock is crashing than a $4.80 average as the stock is going 510, 520, 530, 540, 550. Your average doesn't matter. What matters is if the trend is in your favor. So for me, when I start to see a break of trend, when I see a signal, right? When I see a signal, that's what I'm adding. And that signal for me on the short side is a VWAP break or death candle. What's the inverse? The inverse is if you are a long bias trader and the stock is under VWAP, meaning it's very weak, you're only going to use 30% of your size until either it reclaims VWAP or breaks the high of the day. At that point, your thesis is proven, the trend is in your favor, and then you get to add versus averaging down, the bottom falls out, you're still averaging down. What the hell are you averaging down for?
That's true.
Right?
Yeah.
You're getting bigger as the stock is going against you. It makes no sense.
Yeah. I think psychologically for a lot of newer traders, they really care about the average because it signals safety. Like when you are, let's say you're a short seller, stock is going lower. If you have a high average, you have like $1 or $2 of buffer room, but they only have starter size.
Right.
So you're saying that they should care about adding to that starter size, let's say from 100 shares to 500 shares, as the stock is going in their favor towards the direction that they want.
Correct.
That makes more sense.
You need a signal, right? You just need a signal in everything. So for example, like as a short bias trader, if a stock is breaking the low of the day, if a stock is having a death candle, if a stock is breaking VWAP, those are all signals that this trend is going in your favor. What's the inverse for a long bias trader? If the stock is holding above VWAP, if the stock is breaking high of the day, if the stock is breaking pre-market high of the day, chances are it's going to go higher. So I'm looking for a signal to prove me right and then size up. And until then, 30%. 30% also helps me cure my FOMO. Sometimes it makes me feel like a little bit more calm. But like, let's say, for example, I want to use 10,000 shares. If the stock is going against me and I only use 3,000 shares, it's very easy to stop out. My losses remain small and I don't really care. But then when it breaks and I'm in 10,000 shares, all of a sudden I'm 3x my size on a stock that's going in my favor. It's like you're adding gasoline to an amazing fire that's working for you. But what ends up happening is most traders, they're in 10,000 shares as the stock is squeezing up higher and killing you. And as the stock is going down, they only have a starter.
Yeah.
Right? Makes no sense.
That's true.
So it's very simple. Only add to your winners. Do not add to your losers. And if you see a signal that the stock is doing, get in there. Get in there. It's not always 100%, but wouldn't you rather have a higher probability of the stock going? Like I know for a fact that there's a 90% chance that if stock has a death candle, if it's under VWAP and it's under low of the day, chances are bounces are going to fail. It's not 100%, but it's pretty damn close.
Yeah.
I also know that if a stock is above VWAP, it's trading high volume, it's over the high of the day, and it's over pre-market high of the day, chances are it's probably going to go up. Right? So by using that information, it could help you get in bigger on your winning trades as it's going in your favor. And as it's going against you, you're not more than 30% of your size, and it's very easy to stop out.
Yeah. Going back to what you said as your confirmation, you said the stock for short selling needs to be below VWAP and it needs to show you a death candle.
Right.
What is a death candle?
Right. So a death candle is a big red candle on elevated volume. So usually what ends up happening is a lot of these small cap stocks, they end up kind of pushing up and then they reject. What I want to see is a big rejection candle on elevated volume. So I want to see the volume go up and it just kind of have a big red candle down. What does that signal? That signals that short bias traders are probably covering. It signals that long bias traders are probably trying to buy the breakout, but it fails. Now, all that volume is now trapped and is going to create resistance for you, right? So that's what I'm looking for. When you see it, you know it's a big red candle. It's like think about sometimes when you go long, right? You go long and the stock immediately rejects with a big red candle. You're like, oh, God damn it. Yeah. That candle, that big red candle that you see on elevated volume, that to me is a death candle. That to me is a confirmation that the trend is changing, and that's what I'm looking for.
And these are big red candles you're looking on the intraday 1 minute chart.
1 minute chart.
Oh, okay.
1 minute chart.
Okay, we'll try to put some examples.
Yeah, I'll get you some examples for sure.
Viewers can see what you mean.
For sure.
Okay, interesting. Speaking of executions and all the entry and exits, is level 2 and tape reading still a big part of your execution process?
Yeah, I think it's important, but I think the problem with level 2 is it's very easy to manipulate the level 2. What do I mean by that? Someone could put in a big bid or big offer and kind of try to manipulate the stock up or down, right? But the chart never lies, right? The chart is the executed trades that show up on there. Versus the level 2, it's very easy for someone to spoof, put a 50,000 share bid, 100,000 share bid, and then cancel it. Or 100,000 share offer, 50,000 share offer, and cancel it to kind of, sway the stock. But the executions that paint on a chart are always legit and always authentic, right? Because those are filled orders. So I'm mostly focused on the chart. Level 2 does help, but people always think that level 2 is like this secret magical thing that like if you learn how to read level 2, you're going to see behind the scenes. But I think level 2 is very easily be manipulated, very easy. I'd rather just focus on the chart. You can't manipulate the chart. You can manipulate the level 2.
Yeah, especially for small caps.
Definitely.
Yeah.
Definitely.
Okay, so then would you say for newer traders watching this, they don't need to, do they even need to bother learning level 2 and time and sales? What do you think?
Level 2 and time and sales just comes with experience, right? You could watch it, you could learn from it, but most of the time the chart says everything, right? I would rather have a chart than have the level 2 because the chart has all the data versus the level 2. They could very easily manipulate that level. I've seen it so many times, them putting 100,000 share bid and the stock jumps up, the bid disappears, and then it crashes down, right? The reason why they do that is because they're flashing that 100,000 share bid to sell on the offer with like an iceberg order, a hidden order. So they're selling hidden on the ask and trying to flash that their buy orders here. As soon as they get their order, they cancel this, stock goes down, right? Think about it. If you wanted to buy 100,000 shares of a stock, you wouldn't show your order on the level 2. You try to hide it because someone's going to jump in front of you. So they're showing you what they want you to see,
I see. Yeah, okay. Yeah. I know for large caps, most of the traders who trade large caps, we don't really bother with level 2 either.
Right. And it's very difficult to manipulate a level 2 on a large cap because you need billions of dollars.
Yeah.
Right. Imagine trying to put a fake bid on like an Apple or an Amazon. You're going to need gazillions of dollars versus for a small cap, like, 50,000 shares is 100,000 shares on a $3 stock is nothing.
Yeah, that's true. That's true. Okay. I think that clears up a lot of the questions that some of our viewers may have. You also mentioned that in our pre-interview survey, you also mentioned that last year you actually made more money from long-term investing than short-term trading. Could you tell us a little bit more about that?
Yeah. So the last 2 years, so this year and last year, I'm on track to make more money long-term investing than day trading with realized profits. So that means selling off some longer term assets and still holding the core. So, what I've realized is there's a stat out there that over the past 10 years, 90% of hedge funds have underperformed the S&P 500. So if you've invested in a hedge fund over the last 10 years, the S&P 500 usually is going to beat that, right? And if you look at the long-term chart of SPY or QQQ NASDAQ, it's just straight up. So I've been thinking in my head, it's like, how do I take my, success to the next level? And everyone always says you have to have assets, you have to build your wealth, you have to, make money while you're sleeping. And I never really understood what that was until, a few years ago when I started parking, a certain percentage of my profits into longer term stocks. I wouldn't try to find the next Nvidia. I wouldn't try to find the next Microsoft or the next Facebook. I would invest in already proven names. Google, Facebook, Nvidia, Apple, Amazon, Microsoft, stuff like that. And lo and behold, these stocks are going crazy. They're still going. I mean, Microsoft's up 30%. All these other things are up like crazy. So my thought process is take the money that I make from short-term trading and invest it into longer-term assets. There is no faster way to make money than trading. You can make $10, $20, $30, $100,000 in a day, right? And then what do you do with that money? A lot of traders, what they do is they buy a new car. They buy a new watch, right? They buy a new this, they buy a new that. And what my thought process is let me take some of that money, invest it long-term, let it grow so that I could keep the principal invested, and whatever profits come in, that money I could use to spend on whatever the hell I want. So over the last 2 years, this has been a very, very big thing, is take percentage of my profits from trading and just put into longer term investments. If 90% of hedge funds can't beat the S&P 500, put in the S&P 500. And what I do is I look to see what are the top 20 weights of the S&P 500, because the S&P 500 is 500 of the biggest companies. So if I know that the top 20 weighted are Nvidia, Apple, Amazon, I'm just going to put it there.
Okay.
Right? I don't have to get too complicated. The problem is, when people get into investing, they try to find the stocks that have not yet gone crazy. Like, I have to find the next this, that. I mean, we just don't have access to those resources to do the research, to do whatever. But I know for damn sure that I'm still going to be using Instagram and Facebook. I know that I'm still going to be buying iPhones. I'm still buying stuff on Amazon, right? I know that Microsoft owns 50% of ChatGPT. Like, I know this stuff, right? So why don't I park my money there? And that's what I've been doing.
Oh, so and you realize those long-term investments. When do you decide to realize it? And isn't the long-term in the US, like long-term investments, like taxed differently than the short-term? So how do you make sure that you are still taking those favorable tax routes?
Usually it's about a year. So I think the tax code is if you hold an asset for longer than a year, it's taxed at a lower rate. But if you hold it for less than a year, it's taxed at a higher rate. So for me, I consider tax as the cost of doing business, right? So for me, I don't really try to say, I hold this stock for 252 days and I got to sell it now, because sometimes if you hold it for too long, it might kind of come back down, right?
Right.
So for example, I don't know, Tesla went up like crazy last November into January, right? That could have only been 2 or 3 months. If you say, you know what, let me wait until 1 year passes, it went down like 50%. Right? So would you rather pay the taxes and have higher profits, or your profits disappear? So for me, what I do is I just pretty much wait for, a nice catalyst for them. So for example, one of the recent ones was Microsoft. Microsoft beat earnings. They went up to 550. So I took some off at 550, locked in some profits, still held a core. And now that's kind of back down to 510. I'm just rebuying it back, right? Yeah, I might pay a little bit more taxes, but I've locked in money. I put some money in my pocket. I now have extra money to invest. And that's kind of what I'm doing. So it's more like longer term swing trading, but holding that core position for the longer term, right? So let's say, again, make the math easy. I have 100 grand in Microsoft stock. If it beats earnings, I'll sell 20 grand of it. Right? I'll keep that 80,000 principal, right? Comes back down, I'll just buy it back. And then all of a sudden I'm back to exactly where I was. But now with some realized profits, I get taxed a little bit more. But again, it's overthinking. I don't care, right? If I'm paying extra taxes, at least I'm making money, right? My dad always said that you should be happy to pay taxes. That means that you're making money.
Yeah, that's
right?
true.
So again, everyone overanalyzes this stuff. I'm just, again, the small pieces of it, I'll realize it, I'll take it along the way. And then from there, that's it.
Okay. Besides the stock market, you talked about, yes, you're invested in the top 20 companies in the S&P.
Yes.
Are there any other kind of assets that you invest in other than the stock market?
Definitely. So a big one has been venture capital deals.
Okay.
So now that I'm a accredited investor, right?
Yes.
So there's this rule that you have to have like $1 million in assets, and then you can become an accredited investor. When you become an accredited investor, you get to start to invest in venture capital deals. So I put some money in venture capital deals. The problem with venture is it takes a long time to pay out, but the returns could be substantial, right? So I've put a decent amount of money into venture, into different avenues there. I haven't seen a return yet more than I don't know, like realize where I got dividends, maybe like 10%. So it's not
I
really
see.
anything yet.
Yeah.
But the way it works in venture is, 90% of them are going to do nothing. And then the top 5 to 10% are going to make 10, 20x, right? So
I
it's a
see.
longer time horizon. So I have some money in venture, right? Some money in real estate. I have some money in crypto, Bitcoin, Ethereum. I don't mess around with the meme coins. I don't mess around with any of that.
That's probably smart.
Just the biggest ones, right? The same thing in the S&P is take the Bitcoin, Ethereum. Aside from that, that's pretty much it. I have, watches, which appreciate in value. Cars are a little bit different because unless it's like a special edition, it's not really going to appreciate. So a lot of people don't know that either. So if you're ever going to buy like an expensive car, you never want to buy like the regular version. You always want to buy the special edition because it's limited. So for example, my car is a special edition and I bought it, I don't know, like 5 years ago. I drove it and it appreciated 5 years later.
What car is that?
I don't really. Stereotypical Lamborghini. So it's Huracan Performante. So it's the Performante version. So I drove it for 5 years and it went up in 50K in value.
Oh, wow.
So I would never, ever, ever, if you're going to get a higher end car, do not ever get the regular edition. You always have to get the special edition because it's more limited, it's more expensive, it's more desirable, and you could use it and it appreciates. That's the only way a vehicle appreciates. Otherwise, they depreciate 30% the moment you drive it. So watches, cars, venture capital, real estate, indexes, very, very little in bonds. But I'm always trying to put my money away because what happened is I always thought that the way to get rich was to have the most money in your trading account. I saw these guys have millions and millions of dollars in their trading account. I was like, that's freaking cool, right? How cool would it be to have $10 million in my trading account? But what I realized is the more money you keep in your trading account, the more risk you have, right? Because we're human. We screw up all the time. All it takes is one time for me to be an idiot and lose that money. So I keep my trading accounts very, very small these days so that, number one, I could never put myself in a scenario to ruin my life. And number two is if I'm ever traveling or if I'm ever not trading day to day, I'm making a ton of money on dividends. I'm making a ton of money on appreciation. Like April was tariffs. So we had the crazy, crazy tariff stuff. So I had one of my watches, right? And again, watches are assets. So when that April tariff stuff happened, I was like, oh my God, this is such an incredible opportunity. Like the market's crashing down. Like I know that, we're going to rebound, right? I don't know when we're going to rebound, but I know for damn sure we're going to be rebounding because it's a little bit exaggerated. The market went down like crazy. So what did I do? I took one of my watches that I bought. It was a lot of money. It was about $500,000. I had my watch. I was $500,000. I sold it. I sold my watch for 500 grand, got that cash, invested it during the tariffs. And with the appreciation that the market went up in, right, I was able to now keep that money invested, pull out the profits and buy back the watch.
Oh, damn, that's crazy.
So it's stuff like that. So having hard assets as well, if you know when to time it properly, I mean, it's a huge opportunity. It's a huge opportunity.
Yeah.
So I got that money invested and I got my watch back, right? It's crazy if you think about it, but a lot of these stocks, you look at Palantir doubled during April, right? Some of these stocks went down 50%. So the index went up 30, 40%. Individual stocks went up 100%.
Yes.
You put it in the right place. At worst, if you put it into the indexes, you got 40%. If you put it into the right stocks, you could have doubled up. So I got my money back, right? I got my money back to buy back the watch and I got that money invested again. So it's not always going to be that simple, but that's sometimes when you see when I see an opportunity like that, it's like, God damn, I need more money. I need to put more money into it because that opportunity is so huge.
Yeah, that's true. If you think about it, trading is very active. It's active income. But when you start investing, it's not completely passive, but it's way more passive and less stressful than trading.
Yeah, and I know if, for example, we have a bad month in the S&P 500 or a bad month in the indexes, well, I'm still getting rental income from real estate. If, something happens in the real estate market and, you lose a tenant and they're gone, well, I know that, maybe I'm going to get a dividend from venture. Or if venture is slow and, real estate is slow and interest rates and this and that, well, then I know that maybe I'm going to make some money on Bitcoin appreciating or maybe here. Or if all that's not working, I'm still getting dividends.
Yeah.
So it's always something's happening, right? Always something is happening. That way it makes me feel, at least for myself, a little bit more comfortable and not feel like I need to force a trade, not feel like I need to, participate in things because I have all around money's coming in. It's not, and also it's not all the same time flushing in. Sometimes one is slow, sometimes one is better, sometimes one's not, sometimes one's this. But the more money that you make and the more that you could invest in and spread it, the more protection it gives you.
You're more diversified as well.
Yeah.
Yeah. Another thing I noticed is you're married.
I am. I am married.
Yeah, since the last time we talked too.
Yeah.
How's I don't know. So how's being married?
It's good. It's pretty much, I don't know. I think it's the same. Once you like actually really know someone, like for me, like nothing really changes.
Okay.
It's nice. She's making me travel more, so not trading as much, but like traveling. It feels like every month now, which we gotta slow down. But it's good. Aside from that, I mean, it's nice to have like for me like a support system, right? So. She's really bubbly. She has a great personality. She's always like in a good mood, which is great because if I have a bad trading day, she's always the one that says, let's get out of the house. Let's go get ice cream. Let's go leave. If I had someone that was more serious like me, it'd probably be very, very difficult, right? Because like for me, I was always the type of person that's like suffer in silence. I'll deal with it myself. I don't need any help. Like I've been through this before. Let me just deal with it. But having someone that forces you to, go out, take a breath, or someone that forces me to take time off and travel. I'm always working, I'm always hustling, I'm always up to something, but she forces me to, go out, have fun, and like enjoy the fruits of my labor because, after 11 and a half years of trading, it becomes very daunting. You're exhausted, right? I mean, like, I have white hair, it's crazy. I'm still
from trading.
Yeah, from trading. So having someone that says, what, great job today. Let's go out, let's celebrate. Or, you know what, today was a really tough day, let's go get some ice cream. Normally I would just sit there and like watch a movie and like mope around, right? Now I'm still moping, but I'm getting ice cream. So like it helps a little bit. But I definitely found someone that, is like my missing puzzle piece.
Aww.
It's my person that like really understands me and the person that will like help me to always try to get better, right? She's always like rooting for me. She's always trying to like for example, like if there's ever a scenario where like a stock is going against me or if I'm having a bad day, like I'll text her. I'll be like, hey, like stock XYZ is squeezing up. Like I'm having a pretty shitty day. Like I'm sorry. Like I can't do X, Y, and Z. And she's like, don't worry about it, this and that. And then what she'll do is she'll like open up a tab on her like computer. If she sees the stock is going down, she'll send me like little memes of like celebrating or like cheerleading.
So cute. Oh my God.
So like, and if the stock is going like against me, she just won't say anything. Like if it's squeezing up still higher, she won't say anything. So like just having like that support has been really, really nice.
Oh, I imagine she's not in the same industry, right?
No, definitely not.
Okay. That's probably good.
Definitely
not. That would be bad if
it's tough. If you have two partners that are traders, it's very, very tough. I don't recommend
having
it.
Two crazy people in the same marriage. That wouldn't work. You can only have one person that's crazy, and this one's you.
Yeah, I mean, it's me, right? I'm the crazy one. She's not crazy. If you're listening to this, if you're watching this, you're not crazy. You're perfect. You're great. I love you. She's definitely the crazy one.
Oh, okay. But you're crazy in a different way.
Yeah, I'm crazy in a different way. I'm crazy in the trading world. She's crazy in the real world.
Oh, okay. Oh my God. Would you say since being married, that's kind of like major, I guess, because as traders, your life, it's very volatile.
Yeah.
But I think it sounds like having this marriage, this relationship grounds you. Right. So you have kind of like another life outside of trading.
Definitely. What I've been trying to do more is I started trading when I was very young. I started trading when I was 19. So I'm 30 right now. My birthday is actually in a week. So really excited to be 31. But I was always risk seeking. Right. So I was always willing to risk. Always. Like I'm young. Now's the time to risk. Now's the time to push. Like I want to go for it. Right now, while I have the highest stress tolerance, while I have the most time to make back money in case I fail. But as I've kind of found a partner and, tried to, almost like opened up a new chapter in my life, I've also been trying to be more aware that I shouldn't be as aggressive because now I have someone else to take care of. Yeah. Right? I have someone else that's really, really important and I shouldn't be, betting the farm unless it's that great opportunity, unless it's amazing, because now I have someone else that I have to take care of. So for me, I've kind of, slowed down my risk on the day to day just to kind of be more comfortable, more confident, more laid back, because I don't really want to be risking crazy money, because that also means you could have big losses, right? There's been plenty of times that I've been with her, I've had ginormous losses, right? Like my biggest loss ever was $450,000 in one day, right? And that was a tough day. I hate that. I'll send you a photo, you can pop it up, but that was really tough and I hated that. And it was all my fault. I made a ton of mistakes. And what she did is she came over, she gave me a hug. We went to the Cheesecake Factory. We got some cake, and it was great to be with her. But from that moment, I was like, dude, I do not need to be putting myself in a situation like that, especially when I have someone that actually loves me, cares about me. And I don't need to be moping around and sad unless it's warranted. I don't want to put myself in a scenario where it happens more often than it should.
Yeah. Oh, that's a lot of that shows a lot of growth and maturity as a trader too.
Yeah. And I could only imagine what it's like when you have kids. I don't want kids anytime soon. We're still enjoying our life and stuff. But I could imagine that when you have a child and you have another responsibility like that, it takes it to the next level.
Yeah. Yeah, I would imagine. Do you still, because I remember when we talked 3 years ago, you said you keep your account around $50K. Do you still do that?
Yeah.
Or
Yeah, usually keep it around $50K. And then usually what I do is because trading has been so well, I wire out, at the end of the week or at the end of the month. I think I'm due for a wire out now. Actually, I'm sure I could show you, but let me see.
Then you just wire in if there's a really great setup.
If it's a really, really, really A+ setup, I'll wire in. But most of the time, I'm wiring out.
I see.
I'm overdue for a wire out now. So if you see the current is 92 grand in there.
Okay.
Yeah, 92 grand. So I should probably be wiring out 40 grand,
I see.
tomorrow, take some money out.
Okay.
And that's it. But aside from that, I said, people think that you need to have gazillions and gazillions of dollars to trade very profitably. These days, they give you 4 times leverage.
Yeah.
Right? You don't need much money, right?
Yeah.
Even with 100 grand, you got 400 grand in buying power. For a small cap stock, you're not going to be using that much size anyway, right?
Yeah.
So for me, and also it allows me to, God forbid something bad happens, it's not really going to hurt me if I lose 20, 30, 40 grand, right? But if I have $1 million, $2 million in the account, all of a sudden, 100 grand, 200 grand, 300 grand, doesn't really matter. You're it'll come back. And then all of a sudden it's gone. You're like, what the hell did I just do?
Yeah.
Right?
Okay. To close off this interview, what do you have? Do you have any tips for newer traders watching this who aspire to trade like you or eventually, gain as much experience as you have?
Yeah. I think the biggest advice is something that we talked about is only add to your winners.
Okay.
Don't add to your
losers.
That's a
good one.
If you could just simply do that, oh man, you'll be so good. Because everyone always just adds to their loser. I hear it all the time. I'm in 500 shares when the stock is going against me, but when it's going for me, I only have 50 shares. What do I do? Why the hell are you adding to the loser, right? Why are you adding? Oh, I want to fix my average, right? And then when you get a starter and it goes down or does exactly what you want, you don't add, that's a problem, right? So I would say number one is only add to your winners. Don't add to your losers. It's obviously easier said than done, but try it for a month and see what happens, right? Try it for a month, see what happens. I think number two is grading your setups. The same thing we spoke about 2-3 years ago. Same thing now is if you do not know what stocks or what setup you make the most money on, you have not earned the right to size up yet. I know exactly what setups, what stocks I make the most money on, and that's how I know when I should be sizing up. So go back, track your setups, track your trades, make sure you know that if a stock is on day 2 and it rejects VWAP and that's how you make your money, the next time a stock is on day 2 and rejects VWAP, increase your size. If you know that on day 1 when a stock is reclaiming and doing this and that, you lose money, stop adding to those losers. So just find out what setups, my best setup is not your best setup. You know exactly your best setup. And when you see that best setup, you size up. If you don't know what your best setup is, you have not earned the ability to size up. And the next thing is just be patient, right? It takes time. We were talking before we started the podcast is my first year I lost money. My second year I broke even. My third year, I was making $100 a day, right? And then after that, it's like the chart goes like this. The chart goes this.
Always dip first.
This.
Yeah.
Then this. Then this. Right? So take your time. And then aside from that, I mean, once you make it, right? Bao says the best. He's like, you only have to get rich once. Once you make it, take that money, park it elsewhere, let it generate income, and go enjoy your life, right? I'm setting myself up so that, knock on wood, in the next 5 years, I never have to work another day in my life, and I'll make millions of dollars from the passive income, right? It's going to take time to set it up, but I know that that's the path that I'm trying to do. Generate cash short-term from trading, invest it long-term, and that's it.
Very wise words. Where can people find you if they want to follow you on X or Instagram?
Yeah, so actually what I did is I started a new YouTube channel. So I'm doing live trading videos on a new YouTube channel. So it's called Alex Temiz MIC. So I'll send it over to you, but that's pretty much the main thing that I want people to see. Twitter, X, Instagram, I don't really use too much anymore. I'm just posting live trading videos every single week. So literally the exact same trades with entries, exits, commentary. I'm just posting a weekly live trading video on YouTube.
Okay, cool. Thank you very much, Alex.
Thanks for having me on. It was awesome.
What an incredible conversation with Alex. From selling the rims of his car to funding the trading account to building over $11 million in verified profits, his journey is a reminder that success in trading comes from resilience, discipline, and of course, a lot of hard work. If you enjoyed this episode, make sure to share it with a fellow trader, tap the like button down below, and subscribe so you don't miss another future conversation. We have many more interviews with pro traders. You can check out the next episode over here.